Hello everyone, welcome back. Today I want to talk about funding. And if you remember my last video where I was talking about career path, career paths you can choose when you have done your business studies, I did some sort of categorization of different businesses. And I categorize a business as a startup if you are working on some sort of technology or big project that is not going to generate any revenue for an extended period of time. So usually you would have to build a product or some sort of technology or even a business model that takes long to implement, and that's why funding is really relevant here. First, I want to start and give you one of the most important lessons I learned about entrepreneurship, and it's the principle of affordable loss. So, in general, you have two ways to go about such a project, and they are in academics referred to as causation or effectuation. So, causation would mean that you write a business plan, you do your budget, you have a very clear picture of what you want to build, and have it planned into detail. For effectuation, this is more in the sense of discovery theory, that you will commit to a project and then see where it leads to. So you have more reflection or feedback loops. You do have pivots or shifts in your product development or also in your business model, and you have like some sort of an open mind towards competitors. And here, the crucial thing is that you think about the potential of your startup, not as that's the this and that is that amount that I want to like achieve in profit or in personal income from the startup, but you commit yourself to a time slot to or a monetary value that you are comfortable with losing. So let's say you want to build some kind of software that you don't calculate how much you want to profit from it, but but you define for yourself, I want to commit for 6 months, and I will assign a budget of 50K from my own investments towards it. This way, you are more likely to work in the effectuation framework instead of causation, since the several studies will show that the effectuation approach is the more useful one. So let's go to the timeline. Usually, this bootstrapping is connected to effectuation and your affordable loss. If you build your software in the time frame of 6 months, you will most likely be bootstrapping when having expenses or other costs for your business if you need to invest. In general, this belongs to the pre-seed phase, and this is the stage where you're definitely not in the revenue phase. So I would bootstrap if you don't have any clear investment cases beforehand. Bootstrap your company up to 100K. This means building the strategy, the business model, maybe a first MVP, a minimum viable product. Next is family, friends, and fools, up to 500,000. There you would reach out in your network and see whether people want to support your project that is still pre-revenue or not. The next phase is the seed phase. Here you can see angel investors. There are professional ones. You can reach out to family offices or even investors that you don't know from your network, like here, that will invest in your business if they're convinced that you can build something that might become successful at some point. This is also possible with some early stage VCs. Here I wrote down a bigger cap on the amount that you are trying to get. Next phases are alphabetical, so you have your Series A, Series B rounds, and up to Series F, or I never heard of Series G, but also possible. Here you would go to investors where usually there is a pretty straightforward way you go. So you start with VC, then you have private equities, hedge funds or strategic investors like big competitors. And the reason for that is they all have a different risk profile that they want their investments to have. So VCs, they go the strategy that they fund a lot of projects and they don't really care if some of them fail because they have big upsides when just one of the projects gets traction or even becomes a unicorn or a big corporation. Private equities, later, they do have some other intentions in investing in you, so they are a little bit more risk averse than VCs. Same goes for hedge funds and strategic investors usually too. The last step in your timeline or in the life cycle of your startup would be an exit if you don't want it to be a successful corporation that remains under your control. Are usually IPOs, so you sell basically all your shares via stock exchange, or you merger with a competitor or like a corporation that is strategically aligned with yours, or you get acquired by either a big competitor or a big PE or hedge fund or other investor. So exit would be your last timeline, and usually the cash that is injected into the firm is what is your core remuneration when we're talking about a startup or a big project that you did for several years. So here is where your personal purse will get the biggest. I will get quickly into how your capital should be deployed, in my opinion. So through each round you go here, it will have to change, but one important aspect is what are these VCs or private equities or investors looking for. So in my experience, you can't get to the next round with either one of them. So if you're at the stage of family, friends, and fools and want to get to angel investors or VC, people that don't know you personally and still are asked to give you money, you most likely have to have first a product. So some sort of minimum viable product or business case that you already have if you're a service-based business, something you can show that you worked on and will be useful in the future. Next is customer acquisition, because when you go to the alphabetical rounds, I call them, it's really difficult to get funding if you can't show any traction, if you can't show that you went to the market already. This means you will have to build something that is applicable in the market with a budget of below 2 million if you follow this logic. If you're not a first-time entrepreneur, if you have some other measures that you can show, if you had if you already did a career in your specific field or have some other edge, it might be possible to do it other ways, but mainly if you're a first-time entrepreneur, if you don't show anything other than a valid idea and business case, without traction, you won't get past seed round. The next fields I would invest the money in would be the team building, since these kind of VCs and early stage PEs and even PEs following to that are going to look at your team. If you ask people in VC or PE, they will tell you that after a certain stage, the team is one of the most important indicators of success for your startup, for your business. Next, operational scaling and also funding preparation. So for the first phases, it's still important to be prepared even for your family, friends, and fools. You will have to know who's in front of you and what do you want to present for them. But the later you go in these stages, the more you have to show for, just to be in contact with the specific people. So just the cash you need to employ to get through such a funding round will increase every funding round. So for example, at this stage, at the exit, you will most likely pay a lot of money for lawyers that do your due diligence, for strategic advisors, and then also for investment bankers and M&A specialists. And even in the seed phase or Series A, Series B, if you're not like really involved in the logic of venture capital and private equity, you are most likely going to need help with your funding preparation. So first, for capital deployment, issues can be viewed as even a timeline, else this is understood to be priorities, according to my view. Let me get to the next subtopic, and this is valuation. So why is your valuation important? At the first stages, you will have to show the VCs, the investors, an investment case. So they will decide whether the risk is worth the reward. So they will look at your valuation now, how much is the valuation going to change over time, and what their X is, in this case, their reward, their yield. And for that, you need a clear valuation. Also, if you go to the, if you do an exit, or even in the rounds before, you will have to make sure that you don't dilute your equity. This means that you give away your equity for a price that is not aligned with your own personal interests, and that's why evaluation is important. So there are a lot of ways to do evaluation. The most common ones are actually the DCF method. There is also an EVA method that is employed by some of them, but it's not so common. And from a mathematical standpoint, I deem this to be the easier one to understand and also to calculate. Then usually applied in earlier stages are multiples. So you take some sort of a KPI from your business, a profit, a revenue, and you calculate them, multiply them by a multiple that is attached usually to your niche or your industry, and those you can just Google. So in the DCF method, you would calculate your cash flows, discount them. It's mathematically a little bit more complicated than multiples, but for early stage startups, even for startups, it's okay to work with multiples and don't have big DCF models applied. Also, if you think about the cash flows that are generated by your business, if you are in technology or if you have something highly innovative that you don't have such product market fit yet, the multiple valuation is more likely to lead you to a bigger number, since the multiples that you will find in the specific fields are more likely to be higher. So if you work in like really specific tech, you will have a revenue multiple of almost 5 or even 10 with some specific industries. If you are a retailer, you will have a revenue multiple of maybe 1.2 or even 1.1. So these are numeric valuation methods, and they always rely on your numbers. So either cash flows, revenues, profits. Now, what if you don't have any of them? There are some, I call them heuristics, other methods to look or to give your valuation a specific number. So there are other methods that you can use in order to reach a number without having any revenues or profits at the stage you are. And these are some of them. There are others. I would usually go with the cost to duplicate. So you show what you've invested by the time you're talking about an investment, and then you give a reason to either multiply it by something else. So explain why it's more difficult for someone else to duplicate it, and why the valuation therefore should be higher. My second favorite method is the Berker's method. So there you would look at specific areas of your business, indicators, and attach them with a number. So if you have a team that is full of experts and highly motivated, well-functioning team with a big track record, you will attach for this area and a higher value. And if you add them up, so you have your idea, your strategic partners, your team, and other areas. If you add them up, you will reach to a valuation. These are the heuristics you can use in order to come to a valuation that you can go into such investment talks with your investors. That's it for me, and you will see that this topic funding will get much more complicated if you get into it, but this should give you a quick overview and a starting point if you want to do more research about the topic. Otherwise, you can, if you have specific questions, just leave them in the comments. Thank you very much.